Hello, everyone. Good day, good day. Good to be here. I look a little bit better in those videos than I do right now, but great to have you guys here live with me today. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisory Group. I have not shaved now for 8 days. Feels good. A little bit in the summer, let it go. It's realizing how gray my beard is, but I digress. Good to be here today on Monday, August 24th, 2020. Gearing towards the end of summer here, folks. We're getting towards the end of it. Mildly depressing when you start seeing the headlines on the news about kids going back to school and all that. But I digress. Let's get into our guest for today. I'm going to bring him right in, none other than John Courtliff. So today we're pumped and thrilled. There he is, John. Great to have you here. Thanks for joining us today.
Thanks, Rob. Great to be here.
All right. So portfolio manager partner, you're at ICM Asset Management now. We're going to get into it, but basically ICM is an asset manager with a focus on real estate. Been doing this for a while, and we're really thrilled to have you here because investing in real estate is something that people always ask me about. So good to get an expert on the show, John. We're going to get into some questions with you in a bit. First, let's take a look at some quick headlines here. I'm looking at the Dow Jones Industrial Average on my screen, 28,242. That might be delayed here on my iPad. I believe it is. Up about 300 points. The S&P 500 up 34.1%. NASDAQ up 67 points to 11,379. That is an all-time high. The Russell Index for the small caps up as well, 12 points. Market is just on fire these days, eh, John?
Yeah, it's been a roller coaster, hasn't it?
Yeah, no kidding. The big headlines on the U.S. side, definitely the announcement overnight, looking at some potential coronavirus treatments. Now, I guess there's doubt over how good this convalescent plasma treatment is going to be a breakthrough. I'm not an expert on that point, so I'll let the pundits debate it. But I do feel somewhat optimistic, John, that there's talk of treatment now almost every week. We're hearing about it, so that's exciting.
Yeah. It's I mean, every week you're right. It seems to be getting closer and closer, and more news about it, which is certainly positive.
We're going to see some earnings on both sides of the border. I am going to go back here. Sorry, my producer is telling me that I can't bounce back and forth between screens. Sorry for that, guys. So on the Canadian side, the Conservatives elected a leader there. That was overnight. Yesterday, the TSX was up today as well. A bit of a slow day on the news. Retail sales numbers were announced as well. Nothing terribly surprising here at my end. So let's leave that out. TSX is up, I think, just a little bit today. Let's go right back into the talk today on real estate. Before we get to that, if you're watching on YouTube, please take a sec to subscribe to our channel. Press the big red button. If you're watching on Facebook, please take a second to like or follow the page. Send us your comments. If you're watching and you do have questions on real estate for John or for myself, please go ahead and put them directly into the YouTube chat, question, comment box, or you could do the same on Facebook. So real estate. Everyone wants to invest in real estate. Maybe we should start by talking about ICM, the company that you work for and the you're a partner at, and what you guys have focused on. You know, what's your story with real estate? How did you start, and when did you get into the role you're in today?
Yeah, ICM was founded in 2003, and was founded by a gentleman who had a long track record of investing in North American real estate for family offices, and ultimately I joined the firm in 2011, and we really started to grow the platform, and we manage today over $1 billion of real estate assets across North America. We invest in Canada, the US, and into Mexico as well. So, you know, we get to see a lot. We see a lot of different markets within each country, and we get to compare and see what we're measuring against. One property type versus another, as well as different cities against each other, not only countries. So, yeah, it's very interesting. I've been in my current role for 4 or 5 years now, and very excited that we've got the opportunity ahead of us to invest in what is certainly going to be a fascinating time in real estate.
Yeah, no kidding. Fascinating is right. Where are you right now? You're located in?
You know what? I'm based out of Calgary, but I'm in Edmonton today. I've got a few site meetings on projects that we're working on. So I'm actually sitting in an apartment unit that I stay at when I come up to Edmonton, and it's in a building that we own. So I'm paying rent tonight to your investors, Rob.
That's nice, convenient. It's a great setup. So you talked about investments in the different cities. Obviously, not all cap rates are made the same, and not all cap rates should be made the same. So where has your focus been? Where did you kind of start your focus on ICM, and why did you kind of choose those areas?
Yeah, I mean, ICM's been focused on all property types since its formation in 2003. A lot of industrial and multifamily and office over time. We've never really held much in the way of retail, and over the last few years, we've evolved. And coming into 2020, our primary focus for this year was industrial and multifamily, and really that's where we saw opportunity even pre-COVID. And I think you've probably seen this across many different industries, but COVID has really acted as a catalyst for a lot of trends that were already emerging, and it's not really that different in real estate. So we think that multifamily and industrial are the two winners, if you will, out of COVID, if you can even call it winners, but industrial even more so, I would say. So, we see additional room for cap rate compression in industrial, certainly, and even a bit in multi as well, where I think retail is far more challenged, and that's been the story of the last number of years. So not really news there, so to speak, but I think that it's accelerated the challenges that the retail were facing. So probably some upward pressure on cap rates there. And then when we talk about different markets,
let's pause just a sec. Let's pause a sec, Joe. Yeah. Talk about cap rate compression. You and I know what that means, but maybe for our viewers, why does that matter? Like, break it down to the really simplest of calculations. Why a compression on cap rates? Why a diminishment of cap rates? Why that matters for the owner of that real estate?
Yeah, you bet. And all a cap rate is the net operating income generated by the property divided by the price that you have to pay to buy that property. So you're buying the forward stream of income that property will generate. So the lower a cap rate goes, it means the income per price paid is going down, and that means the price of real estate is going up generally.
Yeah, so all things staying equal, if you get your $1 million of income for a piece of property, so a piece of property that's fully leased, you get your $1 million of income, a compression to the cap rates would mean your $1 million of income is now worth dramatically more because it's a higher multiple, and vice versa. An increase in cap rate, you'd see a reduction in the price of your real estate.
Correct. Yeah. So you want to try to buy property types and in markets where there is going to be support for cap rate compression, and that will mean that the properties that you buy ultimately go up in value over time.
Let's talk a bit about cap rates for the different sectors and why they matter. Maybe first I'll ask you, what are the most important factors with respect to cap rates that you see them moving? Obviously, there's likelihood of the recurringness or the recurability. I've just made up two words, but that's okay. Of the income, or the recurring nature of the income. But I imagine there's other factors that you look at as risk for a kind of movement in cap rates. What would some of those be?
Maybe just to focus on one that not a lot of people necessarily focus on is the operating costs of the buildings themselves, and typically in industrial and in multifamily, there's a little bit more room for cap rate compression in our view, because the costs to keep that building full are typically lower as a percentage of the rent that you collect. So, for example, in office space, which is most particular, you obviously have a significant amount of tenant inducement, or the landlord is paying a significant amount to renovate the property and the space for each tenant, and those costs are incurred on the front end by the landlord and then amortized over the tenant's lease period. But every time the tenant rolls over, you have to spend those TI dollars again. So, that leaves less room for cap rate compression, because you've got higher effectively costs of that space over time. And it's akin to operating leverage within a business, and typically businesses with higher operating leverage will garner less of a valuation multiple as a consequence.
We're kind of going through that in Winnipeg, and I don't know how. Maybe after this, I want to ask you about the cap rates and the last deals that you've done pre-COVID. But like in Winnipeg, we're going through a situation now where there's a couple new buildings popping up in downtown. Right next to the MTS Center and where the Winnipeg Jets play, and it's like they're sexy buildings, and people are moving in, and that means people from the other Class A towers are kind of moving out. So for the first time in a while, we're seeing a cycle here in Winnipeg where there is some vacancies in some of the kind of office and some of the downtown properties, and they do have to entice people to get and to stay and to sign 5 and 10 years. And as a result, your point about less room for reduction in cap rates, therefore less room for property increase, is a perfect example. The deals that you guys were doing prior to COVID, so maybe what kind of cap rates were we looking at in some of the cities that you were dealing with?
Yeah, I mean, we have been focused on a lot of development activity over the last couple of years, in the belief ultimately that there's a couple of things going on in the market. One of which is not only are we in a development cycle because we need more aggregate space, but there's a significant amount of replacement of what is increasingly becoming obsolete inventory, older inventory that just isn't as functional as it needs to be for the market anymore. So we still think that development cycle or that trend holds as a consequence. But what we've seen over the last call it 12 months or so is we saw a stabilization, if you will, of cap rates across all the property types going into COVID, or they've been largely stable for the last couple of years. Some compression in industrial, some creeping up of cap rates in retail as that space continued to become challenged. But what we see coming out of COVID is and during COVID over the last 6 months, we haven't really seen a whole lot. There hasn't been a ton of transaction activity yet that is reflective of the new environment in which we're in, but we are starting to see it be reflected in land prices, and we are starting to see prices move on multi and industrial, where frankly we've got a significant pipeline, so we are very actively engaged in tracking those types of metrics, and I think that will continue for a little bit here. I mean, interest rates have the floor really came out in March and April, and I think that's one trend that sticks is lower for longer, and as a consequence, we're going to see, in our view, some more cap rate compression in industrial and in multi, and again, for the operating reasons that we talked about with respect to office, we're probably about as low as we can go, with the exception of maybe Class A office in exceptional markets. But I think that there's going to continue to be challenges for retail for sure.
Okay, let's retail. Let's touch on retail quick. That is obviously the Amazon factor, the fact that people were and have been going less and less to malls, outlet malls, retail for the past whatever it is, 5 years or so. So you actually saw kind of an uptick in retail cap rates, right? And I imagine that factor is going to be dramatically expanded when and if those deals start happening again, I imagine.
Yeah, well, I think I mean, I use a bit of a personal example, right? Where my parents had never really bought anything online going into COVID, and this has turned them into online shoppers. So they're certainly late adopters, so to speak, but it's not going to take many people like that to change some of their behavior. To have a material impact on in-store sales versus online sales, and we see that in ultimately the ability of retail tenants over the last 6 months to pay their rent. Rent collections among landlords for retail properties was, depending on the type of property, anywhere from 0 to a high of, call it 70%, right? So it was certainly a very challenging period for retailers, and I think that the fallout, if you will, is really yet to be seen. But I would expect that we've gapped higher in the proportion of total sales that e-commerce will make up, and that's going to be the consequence of in-store sales.
I think some of our last guests that have been on the show, I think we had Bruce Croxton on, and he mentioned basically this just fast forwarded kind of 5 years off the kind of expected growth of online sales, and we just got there kind of overnight, right?
Yeah, exactly. I would expect that we'll probably see some peeling back as the world reopens and reopens, to the point where people feel safe to go back out and visit stores again. So we'll probably see some peel back on e-commerce sales as a percentage of total sales, but it did gap higher. That's no doubt, and it'll probably resume its long-term growth trend from what is a higher starting point. So I completely agree with Bruce's opinion there.
Yeah, for me, you couldn't pay me enough to step foot into a mall prior to COVID, so not much has changed for me. I like buying my stuff online. It's way easier. Bought a ping pong table online the other day. It was like, why would I go into a mall? But my wife regularly talks about kind of missing the old days where she could, go into a mall and do whatever people do when they go to malls, I guess. Let's talk. Sorry, go ahead.
I was just going to say I'm much the same as you. If I never saw the inside of a mall again, I'd be a happy guy.
Yeah, no kidding. Hey guys, I'm Rob Tetrault. I'm live here with John Courtliff, portfolio manager at ICM Asset Management. If you're watching on YouTube, take a sec to subscribe on Facebook or on LinkedIn. No, on Facebook, please take a sec to like and follow. We'd love to have you follow and like our channel. Also, if you'd like a no obligation consultation, at the end of the day, I'm a portfolio manager. So if you'd like to have a no obligation consultation, please go to www.speaktorob.com. John, we were talking about cap rates on the retail side that are likely to actually go up, which would mean less value in a piece of retail rental property. Let's talk about industrial, because you guys do have, so you mentioned you have a little bit of exposure to retail in your current portfolio. Now you mentioned you also had a lot, your big play going into 2020 was industrial and multifamily. Let's talk a bit about industrial, because that's become the sexy kind of topic. Twice I dropped the word sexy now in a show, so I gotta maybe tone that down. But it's become attractive for a lot of investors, and it's all kind of, I'm hearing when I'm talking to asset managers, how they all want to be in industrial. What's going on there, and what's happened to cap rates, and how are you positioning yourselves?
Well, I think that the migration to industrial over the last number of years has been sort of the exact same reason ultimately as the decline in retail, and as people shop more online, we need more distribution and logistics warehouses rather than stores, than physical stores. And we talked a little bit mentioned earlier anyways, that part of this development cycle in our view is the replacement of properties that have increasingly become obsolete or not functional in today's environment. So, it used to be very normal for industrial warehouses to be anywhere from sort of 16-foot clear up to 24-foot clear. But even 24-foot clear these days just doesn't cut it for a distribution facility where, you got to be over 30. So, it's a change of mentality, if you will, in the industrial space, and increasingly as e-commerce grows as a percentage of total consumer spending and the like, it's the demand for cubic footage of industrial is changing, and the property types required are changing. So, I think that there's going to be a significant increase in demand for industrial property over the coming years. I don't think that that's really any secret in the retail space or in the real estate space these days, and we've been very active in that space over the last couple of years, and should be reasonably well positioned to capitalize on that.
The cubic space concept is one that I heard mentioned peripherally, but kind of the first time that I hear about this, because, Amazon made headlines a couple of weeks ago where, they were in talks with, was it the Simon Property Group, I think it was, where they were looking at buying all of their kind of malls for fulfillment centers. Is that deal going to be problematic because of the size of it? Do you think that's going to be an issue?
No, I think it's a little bit different, right? I mean, a lot of those, and there's a lot of emerging, if you will, talk about the conversion of traditionally big box retail stores to industrial properties or distribution or fulfillment centers. And if you think about where those are largely located, that's largely going to be sort of last mile type delivery. But the large distribution warehouses are much larger, if you will, than than even those types of big box facilities, and are going to be more peripherally located. So I think that the conversion concept is an interesting one. It's relatively new concept, if you will, but I think it certainly has merit, but probably as sort of last mile delivery and not so much as a centralized distribution warehouse.
Yeah, if you're paying to build these really large distribution centers or fulfillment centers, you don't want to be paying a lot for your land. In theory, you want it to be, if it's not the last mile center, you want to be outside of Winnipeg, outside of Edmonton, outside of Calgary. You want to be buying land for cheap, I would imagine, right? And then just putting a huge building on there. Yeah,
that's right. I mean, those large distribution facilities are 500,000 square feet and bigger, right? It's those big box retailers are never quite that size, obviously. So it's and just from a location perspective as well, you think about the type of traffic that frequents the location of some of those big box stores. It's not really meant for a lot of truck traffic. So I think that's going to contribute to it as well as just infrastructure and accessibility.
Very, very good point that you're making there. Hey, let's move on to multifamily. I'm curious about multifamily. Sorry, actually, before we move on to multifamily, the actual cap rates on industrial. You said there's some deals now in the pipeline that you guys are working on. I imagine there's been compression, right, in the last eight months or so, or in 2020.
It's still difficult to say. I mean, if you look at sort of the publicly traded REITs as a bit of a proxy, I mean, everything collapsed at the end of March and into April, and the industrial REITs by and large are very close to where they were trading pre-COVID. So that's a reflection of the fact that the market immediately thought, "Oh no," and then realized, "Oh wait, we're wrong." And what we are seeing more actively on the front end of deals is that there is a substantial amount of demand for industrial property right now, and that is starting to have some impact on pricing. So, I expect that you will start to see that reflected in data that comes out over the next couple of quarters. That there is some compression in cap rates, and industrial property values are going up.
I was having a chat last week with the public REIT analyst, and one of the comments he made was that there's a little bit of guilty by association there with respect to the industrial REITs not having kind of gained any value in the publicly traded markets. Because remember, the publicly traded markets are a reflection of what everyone is buying and selling these shares of these securities for on a day-to-day, minute-to-minute, second-by-second basis. But we still have the retail REITs that are down 25, 30, 35%, some of them. And even the multifamily stuff is still down a little bit in Canada. So the industrial REITs that have not recovered as much, do you think he's wrong in that comment, saying that they're guilty by association? In other words, they should be higher, but because they're classified as a Canadian REIT, they're still just kind of in the penalty box because their cousins are down so much?
Yeah, and I think that's also partly just a reflection as well that the Canadian capital markets aren't quite as deep as those in the US, and it takes a little bit longer for price discovery, if you will. But I do think that it's important to distinguish as well between the different types of industrial property. I mean, we talked a little bit earlier about some properties becoming obsolete, and that's true in the industrial space as well. So you have to dig a little bit deeper and look at the types of properties ultimately that each industrial REIT would hold, where those properties are located, and the prospects for the cities in which they're located, and the property type going forward as well.
Okay. So when you guys are effectively owners of real estate, maybe talk a bit about when COVID kind of started initially, the rent deferrals and what that looked like, and how much is still going to be collected and how much is lost, and what that picture looks like. Because I think there's misconceptions in the kind of retail investor in his or her mind as to what actually is going to happen with this real estate that the people like yourselves, like groups like yourself, own. And, is that money lost? Is it, do I get to collect that at some point? And what happens with rent deferrals and everything that was kind of passed through COVID? Because it's not cut and dry, right?
No, it's not. And I mean, we'll obviously have our own experience because we've got a unique set of properties, and different landlords will have had different experiences through this period. But as a broad sort of comment, I would say that in our office properties, for example, where there was a lot of immediate concern, we were counting on ultimately collecting less in the way of rent during the period of COVID than we did. So we had well over 95% rent collection in the majority of our office portfolio, which we weren't expecting. And we had a number of tenants that initially requested deferrals and ultimately came back and said, no, you know what, I don't need the deferral. And they caught themselves up in rent. So we have not experienced challenges in our office portfolio. Interestingly, in the multi side of our business, COVID struck. And, if you remember across the board in Canada anyways, the government came out and said, okay, landlords aren't allowed to kick tenants out of buildings. And a lot of tenants, residences in our buildings, basically thought that meant they didn't have to pay rent. So, we had a few week period where it was like, no, you still need to pay your rent, but there was some working with tenants to defer rent, where necessary. So we had a number of tenants move to, instead of paying full rent on the first of the month, they pay half on the first, half on the 15th, so they could be paycheck to paycheck a little bit. I think what's interesting in Canada and in the US for that matter is we haven't really seen the impact of COVID yet on multifamily. And the reason I say that is the CERB payments in Canada and the equivalent $600 a week in the US, really is papering over, if you will, any challenges that may exist in the coming quarters in the multifamily space. And we don't know what that's going to look like yet. The interesting piece over the next number of quarters for us in multifamily is going to be which property type within multifamily is going to end up being most resilient. I mean, ultimately, you've got Class C, B, and A, where your Class C tenants would be the most likely tenants to have been impacted by job losses during COVID, being service industry type tenants, and most likely to have collected CERB. So they're still paying their rent, but when CERB goes away and they roll to EI, are they going to be able to continue to pay their rent? And Class B is somewhere in between Class A. Most of those tenants are going to be in larger centers, closer to urban centers within those larger metropolitan areas, and more likely to be, and this is speaking in very, very general terms, but more likely to be educated and working in office jobs where their jobs and their employment would have been less impacted. So, what type of property is going to be more impacted, or what subtype of residential property is going to be more impacted than others is going to be something that's going to be interesting to keep tabs on over the next number of months.
In your multifamily, you mentioned three classes there. Are those kind of the three that you guys kind of use? Is that an industry-wide kind of jargon, Class A, B, C for multifamily?
Yeah, I mean, Class A, B, C property would be across the board. Include, you could apply the same to commercial as well. So Class A would be, the best located, new, higher quality, and consequently charging more rent. B is somewhere in between, and Class C would be, smaller markets, older product, built to a lower quality, all that type of stuff, and consequently charging less rent. So, Class A, B, C would apply to all property types.
It's I've heard it a lot associated with commercial, but I didn't know you guys use the same jargon for multifamily. So then multifamily, throughout COVID, you said it's not a potential or likelihood that we're going to see that kind of play itself out over the next while. So are you guys doing any deals in the multifamily side right now?
We are underway on a Class A apartment building in Atlanta, and actually just delivering phase one of that project right now. Just started to lease up in August. So, we do have exposure there. We've got exposure to existing assets as well in Calgary and Edmonton. We do see continued opportunity in the multifamily space. I mean, at the end of the day, it's still a roof over somebody's head, and the population isn't changing. And and consequently, we still think that there's going to be opportunity, but we're being a little bit more cautious about where we think that opportunity will emerge compared to industrial, which we think is it's more certain, if you will, in our minds, anyways, that industrial property is going to benefit from this cycle. And we haven't quite worked out where we think the opportunity is going to be in multi, but we do think that there will be opportunity.
You talked about how the population remains stable. I did see an article last week. It was on, I believe it was on BNN Bloomberg, talking about the growth in Canada of immigration. In fact, it was the lack of growth because there has been no immigration over the last, very little over the last 6 or 7 months. And that had contributed kind of a lot to our growth in Canada. Most of the growth, population growth is due to immigration. With no population growth, let's assume that continues for a while, or reduced population growth. Does that would put a damper, if you will, on the any kind of expansion of multiples and multifamily as well, I would imagine.
It depends on how much new product is delivered, right, and how much of the product underway was catering to demand that already existed versus anticipated future demand. So I completely agree with you. I think what's going to be very interesting, particularly for countries like Canada and the United States, and the US has been sort of in this cycle over the last few years where Trump's policies have been very sort of anti-immigration, when in fact, immigration is a significant contributor to the growth of the US population, and GDP growth is a function of population growth and productivity growth. So if you're wiping out one half of that equation, what's that going to look like, right? So I do think that it'll be interesting to see how that plays out. But I do think that pause, if you will, in international immigration in Canada is certainly going to end up being temporary. And I wouldn't be surprised if in the coming quarters into next year, once there truly is a vaccine, that we get a bit of an immigration push. So I don't think that the government is naive to the fact that the population growth has largely been attributed to immigration, and it's an important part of our larger economic growth.
Yeah, I think I would agree. I don't think they're naive to that either. Guys, I'm here with John Courtliff. John, portfolio manager at ICM Asset Management. They manage $1 billion of real estate in different sectors all over North America, Mexico, Canada, US, retail, office, multifamily, industrial, you name it. They got it. They got a piece. So really thrilled to have you here on the show, John. I want to talk about, you and I off air before we came on air. We're talking about the change in office retail in the future because of distancing and what's happening. So in Winnipeg, for us, I think I mentioned this on my show before, but we are expanding. We took on an extra, 3,000-4,000 square feet. We had a lot of staff, and we just needed more space, and we're growing, and so we took on more space. We're probably one of the only companies that is currently expanding their office footprint in Winnipeg. But one of the key things that the guys were mentioning, the guys and gals that were doing the construction, doing the design, doing all that work, is we're now planning for much larger footprint per employee than we ever were before. So you and I talked about the balance that is going to be less people at the office versus more square footage needed for those employees. How do you see that playing out in the major kind of centers?
Yeah, we're of the view at this point that it's going to be net neutral. That they're and I'm actually very excited for this for our company, for the quality of life opportunity for some of our younger employees to be able to work with a more flexible environment, if you will, and that may mean being in the office less frequently and fewer people in the office at any given point in time, but the need more broadly for more square feet per employee, and that kind of balancing out, if you will, the fact that there are fewer people there at any given point in time. So it's going to be interesting. Again, we're kind of the view at this point that that's probably a net neutral effect. But it'll be very interesting to see, and most people don't necessarily see that. I mean, you guys are expanding. You mentioned that we are growing as well. We've added some people during the last number of months. but we're still a small company, right? We've got 30 people in about 7,000 square feet, so we are not challenged, if you will, in the density in which we've filled our office. But this really applies to the really big tenants who take up a significant amount of square footage, right? It's the banks in Calgary, it's the energy companies, and so on. It's those major tenants who have spent the last 15 years putting more and more people into the same amount of space ultimately, and trying to find ways to be hyper efficient with space. And that's just not feasible in this type of environment. I think that will have some lingering impact.
How do you feel about you've heard, I'm sure some of your friends tell you that, it's never going to be the same. People are never going to go back to work like they were before, and we're always going to work from home, and that's a permanent change to the landscape. How do you feel about that comment?
It's that may be true for a limited number of companies, but I think that it's going to be a limited number of companies, and I think that work is a very social thing as well. It's not just about needing to be at your desk from 9 to 5. It's where we spend the majority of our waking hours, if you will, and you better enjoy it. So if you never get to interact with the people that you work with, there's something missing there. From a business owner's perspective, I think that it does present some challenges. As I mentioned, we've added a few staff over the last number of months, and training those staff and getting them ingrained in ICM's corporate culture and getting them up the learning curve that they obviously need to get up when they first join us is a lot more challenging in an environment where they're not able to be in the office and surrounded by people who live and breathe what we do 8 hours a day or more in their first few months of employment. So I think that not having a beachhead and not having a place where people can interact, be social, form corporate culture and create relationships that are very important, particularly for younger people in their earlier careers, is not a viable prospect over the long term. So, not to mention business development. I mean, this works. This works great. I've been working from home I've been working from a laptop and a cell phone for a decade, but not being able to be out there meeting with developers and other operating partners and generating new deals is much more difficult in this type of environment. Yes, we can continue to move the projects that we had in our pipeline forward, but generating new opportunity is more challenging in an environment where we can't interact physically, and a part of that happens at the office. So.
Yeah, and you just straight up miss people. Like, I just miss people. I miss some of the, you miss the human interaction, right? Like, so many people.
That's right.
How was your weekend, and the water cooler talk, and yeah, it's tough to replicate. And we've been trying to figure out ways to do it, to replicate it through, how do you replicate that part? That's tougher for sure than just, because we could have our calls and we could do the Zoom stuff, but I definitely miss some of the people for sure in the office. Hey, I'm a big believer in investing in real estate and have been for my entire life. My parents, my grandparents come from a family of real estate investors / developers, and I was always kind of learning about it at the kitchen table as a kid. Let's go through the concept of why you think someone should invest in real estate, either through something that you guys are doing, which is an opportunity to invest directly through units of ICM, through one of the investment products that you have, that a guy like me, a portfolio manager for retail clients. So I'm a portfolio manager, Rob Tetrault at the Tetrault Group. I can take my clients' money and invest them on a discretionary basis in an investment vehicle that you've set up, that you've created. Why do you think it makes sense for people now more than ever, or now as much as ever, to invest in real estate? Why does it make sense? Why shouldn't I just buy stocks and bonds like I've always been doing?
Well, I think we're touching on stuff that is really the foundation of why we operate the way that we do. At the end of the day, we think that by buying units of a fund, a private real estate fund, for example, like what we offer, provides people with direct access to underlying real estate returns, absent some of the volatility that the public market will layer on to those underlying real estate returns. And I mentioned earlier that we'd seen industrial REITs, for example, collapse and basically claw back 100% of the losses that they incurred in the first 3 to 4 months of the year. And we haven't seen that volatility in our portfolio. We believe that real estate will continue to be in demand, as we've kind of talked about today, for all property types, some more than others, obviously, and investing in private real estate gives you access to the real returns being earned on the property, rather than the whimsy, if you will, of the public markets, and what the public markets may perceive with respect to any stock or real estate security from time to time.
I don't want to ambush you here with the return question, but are you able to talk about your returns in the past?
Yeah, I mean, historically, we've generated sort of low double-digit total returns for investors, sort of 11% or so, and we see opportunity for us to continue to maintain that track record through this period. Obviously, this year will be a little bit more of a question mark, but it also makes it a good time to invest with us, for example. I mean, the market is pricing things real time, and we are starting to see industrial properties, as I mentioned, move up in price, and we're going to be the beneficiary of that into the future as well. So I think that our track record has been strong, and we see every opportunity to maintain that track record over the next 5 to 7 years as we capitalize on some of the opportunities that we see in market today.
I'm here with John Courtliff, portfolio manager at ICM Asset Management. We're talking about the historical returns and kind of what they see in the future here. So you mentioned a question mark for this year. Now, question mark for someone who owns a stock might mean down 20% or down 30%. You're certainly not seeing, and I know this because I own some of your funds and some of your investment ideas, but you're thinking it might be kind of 5-6%, something like that this year, but you're certainly not. I'm not asking you to put you on the spot. What I'm saying is you're not expecting negative returns by any stretch.
No, and I mean our fund pays a distribution, so there's that sort of baseline, if you will, return that investors earn, and the rest of the return is ultimately through capital appreciation over time. And we have not moved our security price over the last number of months. We've been tracking things very closely, but feel that we are well positioned to be successful with the projects that we have underway over time. And because we are not selling projects actively in the market right now, or needing to crystallize gains or losses right now, time is on our side, and we believe in the fundamentals of what we've invested in, and the future prospects of those investments. So we're sitting tight in that respect, and we'll continue to pay our distribution. And like I said, it's a great time to be buying new assets in this environment when everything is in flux, so to speak, or markets are a little bit less certain. If you can have conviction and make some good bets, if you will, going forward, then you're certainly going to be well positioned to be successul.
Plus, you guys entered the year with a ton of cash, if I recall, right? You guys had like 20 or 25% cash in 2020.
You can never time that side of the business, but we were certainly fortunate to enter March with 25% cash on our fund's balance sheet, and that ultimately means we had a very deep pipeline of industrial and other opportunities as well, and we took 3 months, 4 months to put everything on hold and reassess and reevaluate, but we've started to go hard on some of those deals, and ultimately that's with a greater degree of conviction, knowing that we've had the chance to reevaluate the situation in respect of each, and feel very comfortable with the return prospects for a lot of those industrial and other deals going forward.
What's the current distribution, roughly, on the
it's a little shy of 7%.
Just under.
Yeah.
Just under 7%, and so I guess the next question I want to ask you is just to put this in context with where interest rates are at right now. So interest rates have fallen to basically, I'll call them all-time lows, give or take. We're pretty much near or at all-time lows for the 5-year, the 10-year, the Canadian. I've done some real estate projects on the side here where you're now seeing people renew for less than 2% on 5-year deals and stuff. So there's amazing opportunity there. Maybe talk about how that's one of your biggest expense, I would imagine, on your balance sheet typically, or on your income statement. And then how that is likely to have a positive, I would imagine, a positive impact on cash flow.
Yeah, it will over time. I mean, as you sort of alluded to, it's going to depend on when you're able to renew those mortgages on properties, and we carry a mix of fixed and floating debt across our portfolio. We typically, going into a project, we more often than not will go with fixed rate just to shelter against upward rate movement, but those loans will be maturing and renewing over the next 3-4 years. And as I said, I mean, at the outset, I think we are in an environment lower for longer, and I think that we're going to have some great refinancing opportunities over the next number of years as we refinance those investments or those properties at lower interest rates, and that should be quite accretive to our cash flow from the existing assets that we do hold.
How long would you guys go out on a refi? Would you go 10 years or 15 years, or what would be the longest you'd go?
Yeah, it depends on the asset. We put new 10-year money on an apartment deal in Calgary in the fall of last year at 2.5%, and that seemed like a great win in the fall, right? And now that same 10-year money is 1.7, 1.8%. So so we will always have sort of a blend of rates and durations, if you will, in our loan book, and we will always try to lock in when we think that rates are attractive, and now is certainly a time to do that if you've got the opportunity. So we're excited for a number of the projects that we have that will be completing in the next 12 months to get those stabilized and to refinance the construction mortgages out with long-term debt at what we believe will be very attractive rates for sure.
Okay, good. Reminder, gentlemen, ladies, everyone who's watching, viewers, I'm here. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management, Wealth Advisory Group. I'm here with John Courtliff. He's PM, partner, portfolio manager at ICM Asset Management. We're talking real estate investing. We are kind of approaching the end of our time here, John, but I do want to chat with you with respect to investing opportunities for individuals. So my view has always been, if you're kind of a retiree and you're looking to have some conservative, stable income with less volatility in your portfolio, you used to have kind of one choice, which was bonds or GICs or term deposits. And, you guys didn't exist to the retail investor 10 years ago, or I don't know how long ago, but for sure 10, 15 years ago, you couldn't walk off the street, deal with a guy like me and buy ICM. Now that this is possible, my view, and for the viewers out there, this is not even really a question, more than a comment, and I'll let you touch on it. But more than ever, if ever someone wants consistent cash flow, tax efficiency, because I believe a portion of the majority of what you guys pay out is classified as return of capital, ROC, which you're not getting taxed on. If you're a holder of your units in a non-registered account or in a corporate account, you are not being taxed on it. Additionally, and this is not just you, it's all the private real estate, most of the private real estate companies that exist out there, and we know a bunch of them, and we're dealing with a bunch of them. But if you have a corporation and you have much more than $1 million in a passive investment corporation, and you also have an active operating company, in Canada, there's what is called the passive income grind, which starts at $50,000 of passive income. At $50,000 of passive income, you start to lose the small business tax exemption on the operating side. So I've always thought you guys were a fantastic way to do that, because the income that's being generated is not going to push that passive income up in a corporation. So I'm a big believer of owning you guys in a non-registered account. I'm a big believer of owning you guys in a corporate account. I'm a big believer of retirees, individuals who are on a budget or a fixed income that need a specific income to come in. You can't go to bonds. You can't go and buy a 10-year Bank of Canada government bond, which is, it's not going to put bread on the table. So I'm a big believer that you guys, you make a ton of sense for a lot more people than ever, given the market conditions. And as much as that's not a question, I'll let you comment on that if you have anything to add on that point.
Well, I appreciate the support, Rob. No, we agree. I think broadly alternative investments have made great inroads over the last number of years, and that's really come at the expense of traditional portfolio allocations, and we think that's got some room to run yet. I think that the last 10 years certainly have shown, 15 years have shown a great degree of volatility in the public markets, and that there increasingly are options outside of public market securities to earn, what is reliable income and hopefully growth over time as well. And we fall into that bucket, and there are a number of other alternative investments that fit the same bill, so to speak. And I think that broadly, as an asset class, alternatives are poised to be very successful over the coming years as a consequence.
And I think if you're out there and you're watching this and you're thinking, I'm just going to go and buy alternative assets myself, I would just caution you. There's a ton of due diligence that goes in kind of our job in finding partners to make sure it's the right deal, risk tolerance, tax consequences. You want to make sure you know management. And so there's a lot of kind of moving pieces that go with this, but it is an incredibly efficient and neat way to add exposure to your portfolio that probably a lot of Canadians don't have right now. I don't remember the latest stats and data, but I know alternatives 5 years ago were barely existent on the Canadian retail investor. Now we're starting to see some. We're a big believer that it fits for most people. And it's not just what you guys do, right? There's a lot of different ways to invest in alternative asset classes. For me, the key is, an uncorrelated return to the stock market, right? Like, that's very important. You don't want to have to worry. And we saw it in February, March, right? If for someone who was looking at their statement every month and looking at, their stocks or their bonds or their preferred shares versus their alternatives, you guys did this, right? And then we saw that and that on the stocks and the bond side. So although we are back where we were roughly on the S&P 500 prior to, that volatility was not pleasant for most investors, I would say. So you guys are an alternative to that. I feel like I may have interrupted you here. Were you going to add something, John?
Well, just that unpleasant volatility probably contributed to the gray hair in your beard, right? But I think the other piece is you're right. You touched on it earlier, and maybe some of the numbers behind that. If you look at Canadian pensions, for example, they've been investing in alternative investments for the last couple of decades and growing their allocation over time. And some of those investors at this point are up to 30 to 40% of their portfolio is invested in alternative investments. And while an allocation that high certainly doesn't make sense for an individual investor, to put that in context, individual investors are currently allocated less than 5% to alternatives typically. So it shows you the gap in the way that large institutional investors are allocating relative to where individuals are, and not that individuals ever get to where those institutions are by any stretch, nor would it be appropriate, but the types of investments that would be characterized as alternative are so new to individual investors that there's certainly some run room for that to grow in their portfolios.
We believe it definitely should be more than 5%. Absolutely, John. I would concur with that statement. Although, be careful if you're out there. I'm not advising by any stretch. We're not giving investment advice here. You should absolutely talk to your portfolio manager or your investment advisor before you make any changes to your portfolio of any kind. We are not. We're simply chatting real estate here today. If you would like to talk to a competent portfolio manager, that's me, please go to www.speaktorob.com. I'd love to hear your thoughts, your concerns, your questions about investing. What would be an appropriate allocation to alternatives for you? What would make sense for your portfolio, your exposure, your age, your tax situation? Love to chat with you about that. There's just way less volatility, and it ends up being a more fun portfolio for most people out there when they're not down 30% in 4 weeks like we saw in February, March this year. So I'll leave that at that. I'll give you, before I take the last word, I'll give you the last word. John, anything else you want to add about real estate or interest rates or anything that you see in the future?
No, I'll leave it to you. Really appreciate you having me, Rob, and look forward to seeing you again when we're allowed to.
Yeah, you bet. It will happen at some point for sure. So again, guys, I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tetrault Wealth Advisor Group. Today, Monday, August 24th, the Dow Jones finished up 378, up 1.35%. The S&P 500 was up a full percent. NASDAQ closed at an all-time high, 11,379. In Canada, we were up a little bit here. Really fun to see these markets moving up. I will thank you for your time. I will thank our viewers for tuning in. If you're watching on YouTube, please take a sec to subscribe. If you're watching on Facebook, please take a sec to like and follow. And I should probably take a second. Really excited about our guest next week. Just want to make sure I have this right. Yeah, we're getting an award-winning personal finance blogger and the host of the Mo Money podcast. Her name is Jessica Morehouse, so she'll be on next week. That is August 31st. She's a money expert, a millennial money expert, an accredited financial counselor. We're thrilled to have her on. She's got a lot of viewers, and she's got a really, really, really neat award-winning personal finance blogger. So we're thrilled to have her on the show next week. In the meantime, everyone, I'm going to wish you a great, great rest of the day, great, great rest of the week. Enjoy it. We don't have that many weeks of summer left, guys. Thanks so much. Have a great day.